Something happened in the silver market that hasn't occurred in decades. A single-day move that defies the normal rhythm of how these markets function. A 36% surge that caught headlines, shocked casual observers, and confirmed what many seasoned analysts have been quietly watching for months. But here's what matters more than the percentage itself. The positioning that occurred before this move. The institutional accumulation that took place in the shadows. The derivative stress that was building underneath the surface while most people were distracted by other news. If you hold silver, this video will help you understand what just changed and what it means for your position going forward. If you don't hold silver, this video will explain why this event matters far beyond one metal, one market, or one dramatic day. This is about a shift in the structure of how money flows during periods of economic stress. I'm not here to tell you to buy or sell anything. I'm here to help you understand what's actually happening in the financial system right now, why this move in silver is a symptom of larger forces, and how thoughtful investors navigate moments like this without losing their discipline or their capital. Let's talk about what's real. A 36% move in silver in a single trading session is not normal market behavior. Silver is a global commodity with deep liquidity, traded on exchanges around the world, held by governments, institutions, industrial users, and millions of individual investors. For it to move this violently, this quickly, means something broke in the normal flow of supply and demand. The immediate narrative will focus on a short squeeze, on forced covering, on technical factors. And those things are real, but they're surface explanations. What we're witnessing is the result of structural pressure that's been building for years, now expressing itself in price discovery that's both violent and necessary. Before this spike, silver had been consolidating in a range that frustrated many holders and convinced skeptics that precious metals were irrelevant in a modern financial system. But underneath that quiet price action, something else was happening. Physical demand was rising. Industrial consumption was accelerating. Central bank policies were creating conditions that historically favor hard assets. And institutional positioning was shifting in ways that only became visible in retrospect. The insiders weren't lucky. They weren't gambling. They were reading signals that most people either don't know how to interpret or don't have access to. They were watching inventory levels at major depositories. They were monitoring the cost of borrowing silver in the futures market. They were tracking the widening spreads between paper contracts and physical delivery. They were paying attention to what central banks were doing, not what they were saying. This is how major moves begin. Not with a news headline that tells everyone at once, but with a gradual recognition among informed participants that the conditions for a significant repricing have aligned. The typical reaction to a move like this is either euphoria or dismissal. The euphoric crowd sees vindication and starts making wild predictions about where prices will go next. The dismissive crowd calls it manipulation, a bubble, or a temporary anomaly that will soon revert to mean. Both reactions miss the point. What's happening in silver is not about silver alone. It's a stress signal from the commodity complex, from the currency markets, from the bond markets, and from the underlying architecture of how value is stored and transferred in a highly leveraged global financial system. Most people fundamentally misunderstand what drives major moves in commodity markets, especially in precious metals. They think it's about industrial demand, or jewelry consumption, or speculation by retail traders. Those factors matter, but they're not what causes 36% moves in a day. What causes moves like this is a repricing of risk. A recognition that paper claims on physical assets have multiplied beyond the actual supply of those assets. A scramble for delivery when too many participants simultaneously realize they need the actual commodity, not just a contract that promises future delivery. This is the dynamic that unfolds when leverage unwinds, when confidence in synthetic substitutes erodes, when the gap between financial assets and physical reality becomes too large to ignore. The average investor doesn't spend time thinking about these mechanics. They see a price chart, they read a headline, and they make a decision based on emotion rather than structure. But the institutional players who were positioned ahead of this move understand that markets don't move randomly. They move when the underlying conditions become unsustainable and force a reset. Let's step back and examine the environment that created the conditions for this kind of move. Since 2008, and especially since 2020, the global financial system has been operating under conditions of unprecedented monetary expansion. Central banks have printed trillions in new currency units. Government debt has exploded to levels that would have been considered impossible a generation ago. Interest rates have been manipulated downward for so long that entire markets have forgotten what normal price discovery looks like. This isn't political commentary. This is observable fact. When you expand the money supply by trillions while the actual production of real goods and services grows at a fraction of that rate, you create distortions. You push investors into risk assets because safe assets yield nothing. You incentivize debt because servicing it is cheap. You create asset bubbles in stocks, real estate, bonds, and everything else that can be priced in increasingly abundant currency units. But there's a catch. Hard assets, physical commodities, Things that take real energy and resources to extract from the earth cannot be printed. Their supply is constrained by geology, by capital investment, by time. When the gap between monetary expansion and physical supply becomes extreme, the pressure builds. Silver sits at an interesting intersection. It's both a monetary metal with thousands of years of history as money, and an industrial commodity with critical applications in electronics, solar panels, medical devices, and emerging technologies. This dual nature makes it sensitive to both investment demand and industrial consumption. When institutional investors begin to recognize that currency debasement is accelerating, when they see inflation in real goods despite official statistics showing something different, when they observe central banks trapped between raising rates to fight inflation and keeping rates low to service unsustainable debt, they start looking for alternatives. Gold gets attention first. It's the traditional safe haven, the central bank reserve asset, the store of value that has survived every currency crisis in history. But silver offers something different, a smaller market with less institutional ownership, greater industrial necessity, and a historical ratio to gold that suggests significant undervaluation. If you study commodity cycles, currency crises, and periods of monetary instability throughout history, you'll notice a pattern. Precious metals don't move in straight lines. They consolidate for long periods while the conditions for major repricing build underneath. Then they move violently, catching most participants off guard, repricing rapidly as capital flows shift. The 1970s provide an instructive example. Gold and silver were quiet for years after the end of the Bretton Woods system. Inflation was rising, confidence in currency was eroding, but prices moved gradually at first. Then the pace accelerated. In the final phase, from 1978 to 1980, silver went from under $6 to over $50. The move wasn't linear. It was explosive, driven by a combination of investment demand, industrial consumption, and a scramble for physical metal as paper claims multiplied beyond available supply. That move ended badly for late entrants who bought at the top, but it was extraordinarily profitable for those who understood the cycle, positioned early, and managed their risk properly. The lesson isn't to chase parabolic moves, it's to understand the conditions that create them and position accordingly before the crowd arrives. We saw similar dynamics in 2008 and 2011, though the scale was smaller. Each time, precious metals repriced violently during periods of financial stress, then consolidated again as central banks intervened and confidence temporarily returned. What's different now is the scale of the underlying imbalances. The debt is larger, the monetary expansion is more extreme, the number of dollars chasing a finite supply of real assets is greater than ever. This doesn't guarantee any specific outcome, but it suggests that when repricing occurs, the magnitude could be significant. The 36% move we just witnessed may be the beginning of a larger cycle, or it may be a spike that gets contained. No one can predict with certainty. But understanding the historical pattern helps you maintain perspective when markets move in ways that feel unprecedented. There's a crucial difference between speculation and positioning. Speculation is making bets on short-term price movements, trying to time entries and exits perfectly, risking capital you can't afford to lose on outcomes you can't control. Positioning is recognizing the long-term structural conditions that favor certain assets over others, acquiring those assets gradually at reasonable prices, sizing your positions appropriately, and maintaining discipline regardless of short-term volatility. Disciplined investors don't try to predict the exact timing of major moves. They recognize that timing is largely unknowable, and attempting to optimize for it usually results in being out of position when the move occurs. Instead, they focus on probability over time. If the structural conditions favor hard assets over paper assets, if debt levels are unsustainable, if monetary expansion continues while physical supply is constrained, then the probability of significant repricing increases. You don't need to know exactly when it happens. You just need to be positioned appropriately when it does. This mindset requires emotional control. During the long periods of consolidation, when prices move sideways or even decline while everyone else is making money in other markets, it takes discipline to maintain your position. During the violent moves up, when euphoria takes over and predictions become absurd, it takes discipline not to chase or overcommit. The investors who positioned in silver before this move weren't necessarily smarter than everyone else. They were more patient. They were willing to hold an asset that did nothing for months or years, waiting for the conditions they recognized to finally express themselves in price. This is the opposite of how most people approach markets. Most people chase what's already moving, sell what's declining, and wonder why they're always buying high and selling low. Disciplined investors do the uncomfortable work of accumulating when no one cares and taking profits when everyone else is rushing in. If you were already positioned in silver before this move, congratulations. Not because you're now rich or because the move is over, but because you demonstrated the patience and conviction to hold an asset through its quiet period and benefit from the repricing when it occurred. But now comes the harder part. What do you do next? The temptation after a major move is to either sell everything and take profits, or hold everything expecting the move to continue indefinitely. Both reactions can be mistakes. The more thoughtful approach is to review your position size, reassess your risk tolerance, and decide whether your current exposure is still appropriate given the new price level and your overall portfolio. If silver is now a much larger percentage of your net worth because of the price increase, taking some profit to rebalance back to your target allocation makes sense. This isn't market timing, it's portfolio management. You're maintaining discipline rather than letting one position dominate your financial life. If your position is still within your risk parameters and you believe the structural factors that drove this move remain in place, then holding makes sense. The history of commodity cycles suggests that major moves often occur in waves, not in single spikes. There's typically consolidation, continuation, more consolidation, and further repricing before the cycle completes. What you should absolutely not do is let euphoria drive your decisions. Don't start calculating your net worth based on extrapolating current momentum forward. Don't assume this move validates every bullish prediction you've read online. Don't commit more capital than you can afford to lose chasing what's already happened. The investors who destroyed themselves in previous commodity cycles weren't wrong about the overall direction. They were wrong about position sizing, risk management, and emotional control. They let winning positions convince them to take on more risk rather than lock in gains. They confused a strong move with a guarantee of further gains. If you hold silver, take a moment to feel grateful that you were positioned appropriately. Then return to discipline. Review your plan, reassess your risk, and make decisions based on structure rather than emotion. If you're watching this move from the sidelines, the critical question isn't whether you missed out. It's whether the conditions that drove this repricing are still developing, or if the opportunity has passed. Chasing a 36% move after it's already happened is usually a mistake. If your first reaction to this news is to rush out and buy silver at the new higher price, you're probably making an emotional decision rather than a strategic one. But dismissing the move entirely because you weren't positioned would also be a mistake. What just happened in silver is telling you something about the broader financial environment. It's a signal that pressure is building in commodity markets, that physical assets are repricing relative to paper assets, that the dynamics many analysts have been warning about are beginning to manifest. The thoughtful approach is to use this moment as education rather than a trading signal. Study what happened, understand the mechanics, learn about the difference between paper markets and physical markets, research the historical patterns, examine your own portfolio, and ask whether you're appropriately diversified for an environment of currency instability and commodity repricing. If you decide that exposure to precious metals makes sense for your situation, the right approach is gradual accumulation, not panic buying. Wait for consolidation, which historically follows violent moves. Average into a position over time rather than committing everything at once. Start with an allocation that won't devastate you if you're wrong, but will benefit you meaningfully if you're right. Remember that silver is volatile. It can drop 20% just as quickly as it can rise 36%. The point of holding hard assets isn't to get rich overnight. It's to maintain purchasing power during periods when paper currency is being debased, to diversify away from financial system risk, and to own assets that have intrinsic value regardless of government policy. If you're young and in the accumulation phase of life, a small allocation to precious metals as a long-term hedge makes sense. If you're older and need income and stability, a different allocation is appropriate. There's no universal answer. There's only what makes sense for your specific circumstances, risk tolerance, and time horizon. Beyond the dramatic price move, there are other signals emerging that deserve attention from thoughtful investors. The spread between paper silver prices and physical silver availability has been widening. Premiums on physical coins and bars have been elevated for months. Delivery times have been extending. This suggests that the paper market, where most price discovery occurs, has been diverging from the physical market where actual metal changes hands. Central banks globally continue to accumulate gold, but we're also seeing increased interest in silver from sovereign entities that previously ignored it. This shift in institutional behavior is subtle but meaningful. And when the entities that control currency start accumulating hard assets, they're signaling something about confidence in the currency system itself. Mining supply has been constrained. New discoveries are rare, development timelines are long, costs are rising, and environmental regulations make new projects increasingly difficult. Meanwhile, industrial demand continues to grow, particularly from the solar industry and electric vehicle sector. This creates a structural deficit that can only be resolved through higher prices incentivizing both conservation and marginal production. The derivative markets for silver have been under stress. The cost of rolling futures contracts, the basis between spot and forward prices, and the open interest in options all suggest positioning stress. When these technical indicators flash warning signs, it often precedes volatile price action. None of these signals are secret. They're visible to anyone willing to look. But most investors don't look. They rely on headlines, on financial media, on tips from friends, rather than doing the uncomfortable work of understanding how markets actually function beneath the surface. The insiders who positioned ahead of this move weren't privy to secret information. They were paying attention to public information that most people ignore. They understood that when these signals align, significant repricing becomes probable, even if the exact timing remains uncertain. After a major move like this, the psychology of market participants shifts in predictable ways. Those who were positioned feel validated and often become overconfident. They start believing they can predict the next move, that their analysis was perfect, that they understand markets better than they actually do. This overconfidence often leads to poor decisions, taking on too much risk, or failing to take profits when appropriate. Those who miss the move feel regret and often make emotional decisions to compensate. They chase the asset at higher prices, commit too much capital trying to make up for lost time, or convince themselves that an even bigger move is coming to justify buying after the run. Those who are skeptical feel defensive and often double down on their skepticism. They look for reasons why the move was artificial, temporary, manipulated, or irrelevant. They need to believe they were right to stay out rather than consider that their analysis might have been incomplete. Understanding these psychological patterns is crucial because they create opportunities and risks. When euphoria takes over and everyone rushes in, that's often the time for disciplined investors to take profits. When fear and capitulation dominate and everyone sells, that's often the time to accumulate. Right now, we're in the early stage where attention is focused, but positions are still being formed. The real test will come in the weeks and months ahead as this move either consolidates and continues or reverses and tests the conviction of new holders. If you feel strong emotions about this move, whether excitement or regret or skepticism, take that as a signal to slow down. Strong emotions are usually poor guides for investment decisions. The best decisions are made from a place of calm analysis, not reactive feeling. One of the least understood aspects of commodity repricing is its relationship to currency value. When silver jumps 36% in a day, it's not just about silver becoming more valuable. It's also about the currency it's priced in becoming less valuable. Every currency in history that has been disconnected from hard assets and printed without restraint has eventually lost purchasing power. Not might lose, will lose. This isn't theory, it's historical fact, confirmed by hundreds of examples across thousands of years. The dollar is the global reserve currency, which has given it unique longevity compared to others. But that privilege comes with a responsibility that has been increasingly abandoned. The expansion of the dollar supply, the growth of federal debt, the manipulation of interest rates, and the use of currency creation as a policy tool all have consequences. Those consequences don't appear immediately. They build gradually, then express themselves suddenly. Currency debasement doesn't show up evenly across all prices at once. It appears first in assets that are finite and cannot be printed. Real estate, equities, art, collectibles, and eventually hard commodities and precious metals. When silver reprices violently, it's telling you that the gap between currency supply and real asset supply has reached a level that demands correction. The market is saying that previous prices undervalued the metal relative to the quantity of currency chasing it. This dynamic is invisible to most people because they think in dollar terms rather than purchasing power terms. If silver is $30 today and it was $22 last month, they see silver as more expensive. But if the dollar has lost purchasing power during that time, silver might actually be relatively cheaper even at the higher dollar price. This is a difficult concept to internalize because we're trained to think of currency as the stable measuring stick and everything else is volatile. But in periods of monetary instability, the opposite is true. The currency is the volatile variable, and hard assets are the stable store of value. The United States, along with most developed economies, is caught in a debt spiral that has no easy resolution. Total debt, including government, corporate, and household, has grown to levels that cannot be serviced at normalized interest rates without causing severe economic pain. This creates a trap. If interest rates rise to combat inflation or normalize monetary policy, the cost of servicing this debt becomes unsustainable, forcing defaults, recessions, and financial crisis. If interest rates stay low, inflation accelerates, currency purchasing power erodes, and savers are destroyed. Central banks have been trying to navigate between these two disasters, but the room for maneuvering is shrinking. Every crisis response involves more monetary creation, more debt, more intervention, which sets up the conditions for the next crisis to be larger. Thoughtful investors recognize that this dynamic favors hard assets that cannot be created by central bank policy. If the choice is between holding currency that's being diluted or assets with finite supply and industrial necessity, the structural advantage is clear. Silver's move needs to be understood in this context. It's not a standalone event. It's a symptom of the broader instability created by decades of monetary expansion and debt accumulation, finally expressing itself in price discovery. You don't need to believe in any apocalyptic scenario to recognize that holding some allocation to hard assets makes sense in this environment. It's simply prudent diversification away from pure financial system exposure. Let me be very direct about the behaviors that will hurt you more than help you in this environment. Do not over-leverage. Do not use borrowed money to buy silver or any other commodity. Do not trade options or futures unless you truly understand the risk and can afford total loss. The volatility that created this 36% move can just as easily create a 36% decline. And if you're leveraged, you'll be forced to sell at the worst possible time. Do not chase momentum blindly. If your only reason for buying silver now is that it went up 36% yesterday, you're late and you're gambling rather than investing. Wait for a pullback, build a position gradually, or accept that you missed this move and prepare for the next opportunity. Do not follow online hype without doing your own research. Social media is full of people making extraordinary claims about where prices are headed. Some are sincere but wrong. Others are trying to drive interest in positions they already hold. Your financial future should not be determined by anonymous accounts making predictions with no accountability. Do not abandon all other investments to go all in on silver. Diversification isn't just an academic concept, it's a survival mechanism. The correct allocation to any single asset depends on your situation, but it's almost never 100%. Concentration can create wealth, but it can also create ruin. Do not make emotional decisions. If you feel panic about missing out, or euphoria about gains, or fear about further volatility, recognize those feelings and then set them aside. Make decisions based on analysis, not emotion. Wait until you're calm before taking any action. Do not ignore taxes and transaction costs. Buying and selling frequently, especially in taxable accounts, can destroy returns even if you're directionally correct. Frequent trading generates taxes and fees that compound against you over time. Do not confuse a strong thesis with a guarantee. Even if every structural argument for higher silver prices is correct, the path will be volatile, the timing uncertain, and the possibility of being wrong must be acknowledged. Position sizing should reflect this uncertainty, not ignore it. The professional money managers, the sovereign wealth funds, the family offices that control the majority of capital don't trade based on headlines. They position based on structural analysis and long-term allocation decisions. What we've seen in recent months is a quiet but notable shift in institutional appetite for commodity exposure generally, and precious metals specifically. This isn't retail investors buying coins. It's multi-billion-dollar portfolios adjusting their strategic allocation. Why would institutions with sophisticated risk models and research teams decide to increase exposure to an asset class that was out of favor? Because their models are showing the same thing independent analysts have been warning about. Inflation risk, currency risk, geopolitical risk, and the probability of financial system stress are all elevated and likely to remain so for years. Institutions don't need silver to go to $100 for their allocation to make sense. They need it to outperform bonds and cash over the next decade, which, given the negative real yields and currency debasement, is a relatively modest requirement. When you see institutional positioning shift before a major move, it tells you they were working from information and analysis that retail investors typically don't access. Not insider information, just deeper research and better understanding of market structure. The smart approach for individual investors is not to blindly follow institutional moves, but to understand the reasoning behind them and decide if it applies to your situation. If the analysis makes sense and the allocation is appropriate for your circumstances, then positioning similarly might be prudent. One of the biggest mistakes investors make is applying short-term thinking to assets that require long-term patience. If you buy silver and it drops 15% next month, does that mean you were wrong? Not necessarily. It might mean you entered during a temporary spike and need to hold through normal volatility, or it might mean the move is over and conditions have changed. You can't know without maintaining perspective and reviewing the underlying factors. The 36% move we just witnessed likely took years to set up. The conditions that created it, the positioning that preceded it, the structural imbalances that caused it, all developed slowly before expressing rapidly. If you expect to buy today and see another 36% move tomorrow, you're setting yourself up for disappointment. Major commodity cycles typically last years, not weeks. The moves within those cycles are volatile, with significant pullbacks, even in strong uptrends. Holding through that volatility requires conviction based on understanding, not hope based on recent price action. This is why education matters more than timing. If you understand why you hold an asset, you can withstand volatility without panic selling. If you're just following tips or chasing momentum, the first significant decline will shake you out. Think in terms of years, not days. Ask yourself whether the structural conditions favor your position over a multi-year horizon. If yes, short-term volatility is noise. If no, or if you're not sure, position size should be smaller until clarity improves. What's happening right now is giving you a real-time education in how commodity markets function under stress, how central bank policies create distortions, how price discovery works when paper markets diverge from physical markets, and how investor psychology drives both opportunity and risk. Don't waste this moment. Use it to learn. Read about the history of silver markets, study previous commodity cycles, understand the mechanics of futures and options, learn about mining economics and industrial demand, examine the relationship between currency policy and hard asset prices. The knowledge you build now will serve you for decades. The next crisis, the next cycle, the next major repricing will have different surface details, but similar underlying dynamics. If you understand the patterns, you can navigate future opportunities with confidence rather than confusion. This is also the time to be honest about what you don't know. If you don't understand why a 36% move is possible, learn about it. If you don't know the difference between spot prices and futures prices, research it. If terms like contango, backwardation, or physical premium are unfamiliar, study them. The investors who prosper over full cycles are those who commit to continuous learning rather than assuming they know everything. Markets evolve, conditions change, and humility combined with curiosity is a better foundation than confidence based on a single successful trade. No one knows with certainty what happens from here. Silver could consolidate at these levels, building energy for another leg higher. It could pull back sharply as profit-taking overwhelms new buying. It could chop sideways for months while the market digests the move. What matters is not predicting the path, but being prepared for multiple scenarios. If you hold silver, have a plan for both continuation and reversal. Know at what price you'd take some profits. Know at what point you'd question your thesis. Know how much volatility you can tolerate without making emotional decisions. If you don't hold silver but recognize the broader implications, have a plan for gradual accumulation if opportunity presents itself. Identify price levels where you'd be comfortable starting a position. Decide on allocation percentages that make sense for your portfolio. Prepare mentally for the possibility that you enter a position and it immediately declines. The advantage of having plans before emotion takes over is immeasurable. When markets move fast, the people with predetermined criteria make better decisions than those reacting in the moment. Also prepare for the possibility that this move in silver is just the beginning of broader commodity repricing. If the monetary and structural factors driving this move persist, other commodities could follow similar patterns. Having exposure to the broader commodity complex, not just one metal, might be appropriate. This doesn't mean speculation. It means thoughtful diversification across assets that benefit from the same macro forces that drove silver's repricing. If you decide that silver exposure makes sense for you, understand the crucial difference between owning physical metal and owning paper claims on metal. Physical silver means bars, coins, and bullion that you can hold in your hand or store in a secure facility that you control. Paper silver means shares in funds, futures contracts, or certificates that represent a claim on silver but don't give you direct ownership. Both have roles. Paper silver is more liquid, easier to trade, better for taking advantage of price moves in the short term. Physical silver is less liquid, harder to store and secure, but gives you actual ownership independent of counterparty risk. In a true financial system crisis, paper claims become suspect. If banks close, if markets freeze, if confidence collapses, the difference between having a certificate that says you own silver and actually having silver in your possession becomes everything. This doesn't mean you should only own physical, but it does mean that some percentage of your precious metals allocation should be in physical form, stored securely, as insurance against scenarios where the financial system experiences serious stress. The premium on physical has been elevated precisely because informed buyers understand this distinction. They're willing to pay more for actual metal because they recognize that paper substitutes carry risks that don't show up until it's too late to fix them. After a move like this, it's easy to get caught up in narratives about financial system collapse, about silver going to $500, about central banks losing control, about the end of fiat currency. Some of these narratives contain truth. Central banks have created serious problems that will take years to resolve. Currency debasement is real and accelerating. The financial system is more fragile than most people realize. But hyperbole doesn't help you make better decisions. Neither does apocalyptic thinking. The world is not ending. Civilization is not collapsing. And your primary job is to protect and grow your capital under the actual conditions that exist, not the extreme scenarios that might happen. Hold positions that make sense for the environment we're in, not for the environment you fear might arrive. Stay diversified, stay disciplined, stay educated, and stay flexible enough to adjust as conditions change. The investors who succeed over decades are not the ones who bet everything on the most dramatic outcome. They're the ones who consistently make good decisions based on probabilities, manage risk appropriately, and avoid the catastrophic mistakes that wipe out capital permanently. The 36% move in silver is not the story. It's a chapter in a much longer story about how monetary systems evolve under stress, how markets reprice risk, and how thoughtful investors position themselves during periods of structural change. You cannot control central bank policy, government debt levels, inflation rates, or market sentiment. You cannot predict with certainty what happens next week, next month, or next year. But you can control your own preparation, your own education, your own position sizing, and your own emotional response to volatility. You can decide to understand rather than react. You can commit to learning about how markets actually work rather than relying on tips and headlines. You can build positions gradually rather than rushing in at extremes. You can take profits when appropriate rather than holding forever based on hope. The difference between investors who prosper through cycles and those who get destroyed is not intelligence or access to information. It's discipline, patience, and the willingness to do the hard work of understanding before committing capital. If you hold silver, congratulations on being positioned. Now maintain discipline. Review your allocation, take some profits if appropriate, and prepare mentally for volatility in both directions. If you don't hold silver, don't panic. Use this moment as education. Learn what just happened and why. Make thoughtful decisions about whether exposure to hard assets makes sense for your circumstances. If yes, build a position gradually. If no, that's fine too. Not every opportunity is for everyone. What matters most is that you're thinking clearly, acting deliberately, and staying focused on the long-term probabilities rather than short-term noise. The financial landscape is shifting. Those who understand the forces at work and position appropriately will do well. Those who react emotionally, chase headlines, or ignore risk will struggle. You have the power to choose which group you belong to. Make that choice deliberately, not by default. Stay informed, stay disciplined, stay thoughtful. That's how you navigate uncertainty successfully.